Inside a private sales gallery in Dubai, an architectural model glows beneath a spotlight, while a polished presentation plays across wall-to-wall screens. A sales representative waits beside imported marble samples, but the leather chair across the table is empty. Outside the glass, concrete trucks roll into position as a tower crane lifts another steel beam high above the desert. That physical momentum will not pause tonight. The machinery will keep moving. The concrete will keep curing. The floors will keep rising according to schedules set years ago. But the person who was supposed to sit in that empty chair can change his mind in a single evening. A skyscraper can take half a decade to move from blueprint to handover. A buyer needs 10 seconds to close a property app and walk away. That timing mismatch sits at the center of Dubai's skyline. The most dangerous moment for a property boom is not necessarily when the cranes stop. It is when the cranes keep moving after the buyers have started waiting. And that raises a question ordinary transaction statistics can easily hide. How much of Dubai's enormous property boom has really been selling homes from the future? To understand the risk, you first have to understand what Dubai is actually selling. Reuters reported that off-plan transactions accounted for roughly 65% of Dubai real estate deals in 2025. That changes the meaning of the market. Many buyers are not purchasing a finished apartment they can unlock that afternoon. They are purchasing a render, a floor plan, a contract, and a promise that a specific home will exist years later. The buyer pays a deposit and follows a payment schedule while construction moves forward. There is nothing inherently unusual about that. Off-plan development is a standard model used in fast-growing property markets around the world. It helps developers fund construction and gives buyers access to staged payments. But it also creates a very specific dependency. Dubai is not only selling apartments, it is selling tomorrow. Today's financial commitment is tied to a construction timeline that may continue for years after the original buying decision. So the important question is not whether buyers exist today. It is whether enough buyers will still want tomorrow's apartments when those apartments finally arrive. Once a major project moves beyond launch, it becomes difficult to reverse. Land has been acquired. Architects have been paid. Contractors have been hired. Steel has been ordered. Foundations have been poured. Cranes have been installed. A sudden change in buyer confidence cannot instantly stop that machine. This is where the scale becomes important. Fitch highlighted a planned pipeline of roughly 210,000 residential units across 2025 and 2026, around double the average annual delivery level of the previous 3 years. The agency warned that if supply arrives close to plan, it could create enough pressure to push prices down by as much as 15%. Construction delays may spread those completions over a longer period, so the exact number arriving in any single year can change. But the central issue remains. A large volume of housing has already entered the development conveyor belt. Those units will continue moving toward completion month after month. The supply side is committed. The demand side is not. That difference becomes even more important because a completion is not the same thing as a launch. A developer can delay announcing the next tower. It can change a payment plan or redesign a future phase. But once thousands of units are already excavated, financed, and structurally rising, the range of easy decisions gets much smaller. This is why delivery pipelines matter even before they become finished inventory. They represent decisions that have already crossed a point where reversing course becomes expensive. And that is the first real asymmetry in this story. This creates one of the most convincing optical illusions in real estate. Drive along Sheikh Zayed Road and look at the cranes above the skyline. It feels like real-time proof of confidence. Construction is active, therefore buyers must still be buying. But today's crane is usually yesterday's decision. A tower rising 60 stories into the air may reflect land bought years ago, a launch held 18 months ago, and contracts signed when financing conditions, prices, and investor psychology looked very different. The skyline is a lagging indicator. It tells you what people believed when the project began. It does not necessarily tell you what they believe this morning. That is why a city can still look like it is booming, even after sentiment has started cooling. Concrete reacts over years. Capital can react overnight. And in March 2026, Dubai received a vivid demonstration of exactly how fast that difference can matter. During the first 12 days of March 2026, a sudden regional shock pushed anxiety through Gulf markets. On Dubai construction sites, the towers kept moving. Concrete arrived. Crane operators climbed into their cabs. Engineers inspected new floors. The buildings did not hesitate. Buyers did. According to Goldman Sachs estimates reported by Reuters, UAE real estate transaction volumes during those first 12 days fell about 37% year-on-year and 49% month-on-month. Reuters also reported sellers offering discounts of roughly 12 to 15% in some cases as they looked for faster exits. This was a short stress event during extraordinary geopolitical uncertainty. It was not evidence that Dubai's property market had permanently collapsed. But it exposed the speed difference perfectly. A tower under construction cannot read a headline. An investor can. Concrete does not panic. Capital can disappear from the room before the salesman has finished the presentation. And notice what makes this kind of shock so revealing. It does not need to destroy a buyer's wealth. It only needs to change his sense of timing. A person with enough money to buy on Monday may still have exactly the same money on Tuesday, yet suddenly prefer to hold it. That distinction matters because demand can weaken without buyers becoming poor. Confidence itself can alter transaction speed. So was that the moment Dubai began running out of buyers? Not quite. When the full first quarter numbers were released, the broader market looked far stronger than those 12 stressful days suggested. Dubai's total real estate transaction volume in the first quarter of 2026 rose roughly 6% year-on-year, while total transaction value increased about 31%. That matters because it prevents us from telling the wrong story. Dubai has not run out of buyers. Demand is still substantial. If buyers had already vanished, prices would be collapsing across the board, projects would be visibly freezing, and the central question would already be answered. But the current strength does not remove the future risk. It simply changes what the risk actually is. The issue is not whether Dubai has buyers today. The issue is whether the next wave of completed property will find enough buyers at the prices developers and sellers expect. That is a timing problem, not a zero-demand problem. And timing problems in real estate often begin quietly. Imagine 10 nearly identical apartments in the same completed tower. For months, all 10 sellers expect roughly the same price because buyers have been arriving steadily. Then demand softens. 9 sellers refuse to move. The 10th needs liquidity. Maybe he is over-leveraged. Maybe he needs cash for another business. Maybe he simply prefers a fast exit. So he accepts a lower offer. The building has not crashed, but something important has changed. The next buyer now has evidence that someone sold for less. His question becomes obvious. Why should I pay yesterday's price when another seller has already accepted today's? A market does not need every apartment to become empty before prices come under pressure. It only needs one side of the negotiation to become more urgent than the other. Once enough motivated sellers accept lower prices, those transactions become new reference points, and then psychology begins to shift. The most dangerous word in a property boom is not crash. It is wait. During a rapidly rising market, buyers fear missing out. The logic is simple. Buy now, because the same apartment may cost more next month. But when price growth slows and sellers become more flexible, the logic can reverse. Why rush today if tomorrow might be cheaper? That question can become a feedback loop. Buyers delay. Sellers compete harder. Developers offer more flexible payment plans, fee waivers, or upgrades. Private owners negotiate more aggressively. Those incentives teach buyers that waiting worked, so they wait again. This is why Dubai does not need to lose its entire pool of buyers for pressure to build. A buyer who still loves Dubai, still intends to purchase eventually, but refuses to buy today, at today's price, contributes zero capital today. And Dubai's international buyer base makes that behavior especially easy. In many cities, a large share of housing demand comes from people who are already there and need somewhere to live. Their job is local, their children are local, their mortgage is approved, their lease expires next month. They cannot postpone the decision forever. Dubai has that kind of demand too, but its recent boom has also relied heavily on international capital. A buyer may be thousands of kilometers away, comparing a Dubai apartment with a property in London, a villa in Spain, stocks, bonds, or simply cash. That investor is not physically forced to buy anything. If Dubai looks expensive or uncertain, he can close the browser. That flexibility is powerful. For a family buying its primary home, delaying 6 months can create real inconvenience. For an international investor, delaying 6 months may simply mean leaving money in a bank account or shifting it into another asset. That makes the competition for capital global rather than local. Dubai can build extraordinary infrastructure, offer residency incentives, improve connectivity, and market a global lifestyle. What it cannot do is force someone in another country to sign a purchase contract next Tuesday. And this creates a strange imbalance. The apartment is immovable. The capital is not. The tower cannot relocate to where demand is strongest, but the buyer can redirect money almost instantly. The skyline is fixed in the desert. A large portion of the capital evaluating that skyline is mobile, and when that capital finally enters the market, it faces more choice than the cranes outside suggest. A buyer today is not choosing between one new tower and another. He may be choosing among 3 different markets at once. First, a ready property, finished, visible, and capable of producing rent immediately. Second, a resale off-plan contract, bought earlier by an investor who now wants to exit before handover. Third, a brand new off-plan launch, a fresh promise from a developer asking the buyer to commit again to the future. Those 3 categories can compete for the same wallet. That matters because a developer does not only compete with another developer, it may also compete with its own earlier project. An investor who bought into a previous launch can resell at a discount. A completed apartment nearby can offer a verifiable rental yield today. A new launch must somehow justify why the buyer should ignore both alternatives and pay for another promise. As supply grows, those choices multiply. This can become especially uncomfortable near handover. An early investor may have entered a project expecting to resell before the final payment becomes due. If the market is rising, that exit can look easy. But if dozens of similar contracts reach the resale market together, the investor is suddenly competing not only for profit, but for liquidity. Meanwhile, the developer may still be marketing remaining units in the same project or launching the next phase nearby. Now the buyer has leverage from 2 directions: an individual seller who may need to exit, and a developer that still needs to keep sales velocity high. And more choice strengthens the buyer's ability to wait. Now follow the chain reaction. One buyer steps back. Nothing dramatic happens. The crane still turns. But one less transaction means slightly more inventory competing for the remaining demand. Sellers begin adding incentives. Buyers notice. The fear of missing out weakens. More buyers decide to wait. Resale investors then collide with fresh developer inventory. Ready homes compete with both. New launches become harder to price because the buyer can compare them against a growing menu of alternatives. Developers may eventually slow future launches or adjust schedules, but projects already deep into construction cannot disappear. That is the central threat. The physical market reacts last. The psychological market reacts first. The frightening moment is not when construction stops. It is when construction keeps moving after buyer behavior has already changed. Dubai is not defenseless against that scenario. The city has built much stronger regulatory and financial guardrails than in earlier property cycles. Off-plan projects operate through project-specific escrow structures, with buyer funds controlled and released according to construction progress and regulatory requirements. Fitch has also argued that major developers and local banks are better positioned to absorb a correction than during more fragile periods in the past. Those protections matter. They reduce the chance that a normal property slowdown automatically becomes a systemic financial disaster. They can help keep construction funded. They can reduce the damage from developer failure. They can make the market more resilient. But there is one thing regulation cannot manufacture: a willing buyer. An escrow account can protect money already committed. It cannot create new demand at a specific price. A bank can survive a correction. It cannot make an overseas investor stop waiting. This distinction is easy to miss because financial resilience and price resilience are not the same thing. A banking system can remain stable while property prices fall. A developer can remain solvent while offering larger incentives. A project can reach completion while investors earn less than they expected. Those outcomes are far less dramatic than a systemic collapse, but they still matter to anyone who bought, assuming that scarcity would keep pushing prices upward. That is the limit of every financial defense in this story, and this is where Dubai's response becomes fascinating. Faced with uncertainty, you might expect the city's biggest developers to become cautious. Instead, Dubai often doubles down on scale. In June 2026, Emaar announced plans for a new urban district valued at nearly $55 billion, a project designed for roughly 150,000 residents. That announcement was not the behavior of a company expecting demand to disappear. It was a major public bet that Dubai can continue attracting global capital for years. And that is precisely why the question matters. The city does not need to run out of people who admire Dubai. It does not need to run out of millionaires. It does not even need to run out of people who eventually want to own property there. The scarce resource is more specific. A willing buyer prepared to pay the required price at the required moment. If prices fall far enough, buyers can always return. But lower prices are exactly how markets clear excess supply. And that is where the title of this story becomes more dangerous than it first sounds. Running out of buyers does not mean every investor on earth disappears. It can simply mean running out of buyers willing to validate the last price. A project may still sell at 10% less. A resale owner may still find a buyer after accepting a smaller profit. A developer may still move inventory by stretching payment terms. The market keeps functioning, but the price-setting power has moved. That adjustment can hurt sellers, investors, and developers long before the city literally reaches anything close to zero buyers. So the danger is not an empty market. It is a market where buyers realize they have time. And this is where Dubai's response becomes fascinating. Faced with uncertainty, you might expect the city's biggest developers to become cautious. Instead, Dubai often doubles down on scale. In June 2026, Emaar announced plans for a new urban district valued at nearly $55 billion, a project designed for roughly 150,000 residents. That announcement was not the behavior of a company expecting demand to disappear. It was a major public bet that Dubai can continue attracting global capital for years. And that is precisely why the question matters. The city does not need to run out of people who admire Dubai. It does not need to run out of millionaires. It does not even need to run out of people who eventually want to own property there. The scarce resource is more specific. A willing buyer prepared to pay the required price at the required moment. If prices fall far enough, buyers can always return. But lower prices are exactly how markets clear excess supply. And that is where the title of this story becomes more dangerous than it first sounds. Running out of buyers does not mean every investor on earth disappears. It can simply mean running out of buyers willing to validate the last price. A project may still sell at 10% less. A resale owner may still find a buyer after accepting a smaller profit. A developer may still move inventory by stretching payment terms. The market keeps functioning, but the price-setting power has moved. That adjustment can hurt sellers, investors, and developers long before the city literally reaches anything close to zero buyers. So the danger is not an empty market. It is a market where buyers realize they have time. Could Dubai literally run out of buyers before it runs out of skyscrapers? The evidence today says no. The first quarter of 2026 still showed deep transaction activity, and Dubai continues attracting enormous global interest. But the more important risk is structural. A huge volume of property has already been launched, financed, and pushed onto a construction timeline that cannot respond instantly to changing sentiment. Those homes will keep moving toward completion even if buyers become slower, more selective, or more price-sensitive. If pressure builds, it may not look like a cinematic collapse. There may be no single morning when everyone agrees the boom has ended. The change could appear first, in quieter signals, longer listing periods, softer negotiations, bigger incentives, and fewer buyers feeling pressure to act immediately. It may look much more ordinary: longer negotiations, more incentives, more resale competition, more buyers saying, maybe next month, and that may be enough. Because Dubai does not need to lose the world's wealthy. It only needs enough of them to decide that waiting is smarter than buying today. Back inside the sales gallery, the empty chair finally has a visitor. A potential buyer sits down, studies the model, and listens to the presentation. Then he looks at the asking price. He turns toward the window and watches the crane moving above the city. For the developer, the building is already in motion. For the buyer, nothing is urgent. He closes the brochure. He stands up, and he walks away. Outside, the crane keeps turning. This video is for educational and analytical purposes only, and does not constitute financial or real estate investment advice. Real estate markets can change quickly based on supply, interest rates, regulation, geopolitical events, and investor sentiment. Always consult a qualified financial advisor or real estate professional before making an investment decision. Do you think Dubai's biggest risk is too much construction, or buyers simply becoming comfortable enough to wait? Share your view in the comments. And if you enjoyed this investigation, subscribe for more deep dives into the hidden systems shaping the world's most ambitious cities.